Good evening, guys, and welcome to P2 London School of Business and Finance, P2 ACCA P2. Welcome, welcome, welcome. My name is Martin Jones, as I'm sure you know by now, and I have a slide over my shoulder about to appear to prove the fact. Let me suck myself down into the corner here. There we go. There we go. It's true. My name is Martin Jones, and this is P2 Corporate Reporting, ACCA at the London School of Business and Finance. There's my email referencing the LSBF. And welcome to evening 6. I have a slideshow that we're going to use in order to work our way through what we have done and what we're going to do. And I'll make that do its funky thing right now. Keyboard's just a bit difficult to get to. There we go. On the first evening, we did basic groups, of course, and picked up with changes in ownership on the second week and continued on to complex groups. Then it was foreign currency, where we did a cheeky little number where we started cash flow statements, finishing cash flow statements on difficult evening 4. Difficult because we did our cash flow statement and then went on to current issues. Big evening, that one. And last time I saw you, we did performance reporting and provisions. And although we did finish provisions, we didn't finish the chapter, and we're going to continue with the other standards, including contingencies and events after the reporting period. And here is the official list of stuff that we're going to be doing this evening. So we're finishing off chapter 7 and then doing 8 and 9 this evening. Because we are close to the end, I feel like skipping all the way to the end. This is what we're doing next time. It's got this, we might find actually we pick up a little bit of leases next time that you and I see each other. But we've got two very techy but quite nice subjects. Employee benefits and share-based payment, very interesting actually, but I'll try not to over-invest on those because they don't come up in every exam and they are quite techy, to be honest with you, whereas this subject, financial instruments, does come up on every exam, and therefore I definitely want a full evening doing chapter 12. You'll notice that there is a cheeky omission from this list, and that is chapter 13, deferred tax, and you might have heard me talking about my plans as regards deferred tax. My plan is that we will be doing chapter 13 in a whirlwind of about 15 minutes, which is all it deserves. 15 minutes of the final mentoring session. So when you and I meet together to do the mentoring session, you will have 15 minutes of mentoring, but you will also have 15 minutes of doing chapter 13. Seems to be a good way of utilising the time that we have available to us. And that is a precious commodity. So without further ado, I will bring up the class notes now. There we go. I've been a good boy and put my pen back where it should be. Here come the class notes. Pa-ching! And actually, to help me out, I have also got the paper class notes here on my left-hand side. I always find that useful for me. And here we go. Let's skip to chapter 7. Oh, that opened rather conveniently. Wow, 118, that's rather beautiful. I've been experimenting with jumping straight to page 118 by using the numbers here on the keyboard in front of me. So let's go 118 and see if that works. If I just go ka-ching, does it work? Wow, look at that. That is incredible. So we've jumped straight to contingencies, and there is the basic idea of contingencies. What I am actually going to do is I'm going to flick backwards and forwards between that fella, which is the class notes, and this fella, which is a blank journal. So contingencies. Contingencies, how's this looking? Contingencies. And I think I'll just do the table. Here is the table. And personally, I feel it's worth repeating this table. We've got liabilities traditionally down the middle. with assets on the right, and liabilities are potential outflows, of course, and assets are potential inflows. And there is an inconsistency on this table. Lots of mad stuff on this table. First of all, we distinguish between the different levels of uncertainty in these uncertain cash flows by using the phrases probable, possible, and remote. And probable is just simply defined as greater than 50% chance, implying that possible is a less than 50% chance. Remote is not defined, so nobody knows what remote means as a percentage. And nobody really cares because you just ignore these fellas anyway. And that's what the examiners do. They just ignore this one. In fact, it's the upper fella that typically gets examined. And there is a very notable inconsistency here, because what we do with a probable liability is we provide. But of course, one person's liability is another person's asset. One person's asset is another person's liability. So if you provide for one, you should provide for the other, but we don't. We disclose the other, which makes no sense and therefore frequently gets examined. Not in every exam, but certainly every year, I would suggest, on the basis there are 4 exams a year. It does tend to be either not at all or 2 marks, because the examiner is very fond of examining both a probable contingent liability and a probable contingent asset in one scenario, precisely because of the inconsistency there. Just a style, really. Doesn't seem to be any reason why he does that. You know, why not just examine one or the other? But generally he doesn't. He tends to have both in one scenario. So you will have a potential liability that's a probable outflow and a potential asset that's a potential inflow, and you will do inconsistent accounting for these two. And he likes that, so that's how it tends to come up. It is possible you could be examined on possible, but not really, not very common, to be frank. But for completeness, there is the completed table. And that's it. We're sorted now. So I will just make sure that everyone's there and you're all hearing me and everything's cool. Tell me hi, and I will feel very happy about my life and be able to continue with this lecture injected with enthusiasm. Oh. Hi Troy, hi Bukasam. 16 viewers in the background there as well. Good stuff, guys. Enjoy the evening. Here we go. So it's a bit like last week, to be honest with you, only more so. That's the subject. We're done. So we're going to be going, through simple subjects that come up for 1 or 2 marks, and making sure that we're cool with the, the basics. In every case, there's a little baby example available for you to test. You know the story here, it's recorded in the library, so in the context of the subject we've just done, which is contingencies, we've got the nice question, actually, rather nice question called outrageous, which is 2 marks, as you can see, and that one is recorded down in the library. If you fancy having a look at that, it's in the library. To be frank with you, it's so simple, you'd probably be happy with the answer in the back of the notes, and that would be it. So let's bring that out there. That's a good way of doing it. There we go. And we're into EAP, or events after the reporting period, EAP. And as you can see, there's the technical stuff. We'll stop here for a second, actually. Events after the reporting period, these are referred to as post-balance sheet events, PBSE, and are accounted for as follows. Still very commonly referred to as PBSE, but less commonly now, I must admit. And a post-balance sheet event is defined by that little table there, which is a bit naff, to be honest with you. It's the technical definition. A PBSE that gives evidence of a condition existing at the year end is adjusting, and a PBSE that does not give evidence of a condition existing at the year end is non-adjusting. But that doesn't really speak to us. So what I'd like to do is to translate that into words that speak to us by using this thing, the pen. So here we go. bit of a mouthful, this title, and therefore always abbreviated, as you see there. But that abbreviation is pronounced in different ways by different people. There's a cowboy called Wyatt Earp, and therefore EARP is often called Earp. It is also called EAP, as in EAP. Whatever works for you. But the way that this works is like this. You look at the underlying event. It's all about the underlying event. The recognition of an EAP is based upon the timing of the underlying event is a lovely way of describing this. The recognition of an EAP is based on the timing of the underlying event. And when you have an example in front of you, it's completely obvious what you do. So let's have a little example. So you and I, we are the FD, a financial director of a large entity with a big factory, and our office is in that big factory. We cycle into work because we're ethical financial directors, and we hop off our bike and we can't believe it, the factory has been washed away, including our office. It's gone. And we can see from the fact that there's a big trawler sitting in the middle of the mess that would have been the factory, that the factory has been washed away by a tsunami, by a tidal wave, by a volcanic tidal wave. Shush, it's gone. And, that discovery is called an EAP, because today is the first day of the new year. It's the 1st of April, and our year end was last night on the 31st of March at midnight at 12 o'clock. So we're coming to work on April Fool's Day on the 1st of April, and it's the first day of the new accounting year. And the tidal wave has been discovered. The damage of the tidal wave has been discovered. Now the discovery is called the EAP. The discovery of the tidal wave. The discovery of the tidal wave is called the EAP. But underlying the discovery of the tidal wave is the tidal wave itself. And how we account for this tidal wave depends on when the tidal wave happened. And we speak to the policeman that's, rummaging in amongst the rummage, and he says he doesn't know when the tidal wave happens, but he thinks it happened just after midnight, maybe 12:30, maybe 1 o'clock in the morning. In which case, it's a non-adjusting EAP. It's a non-adjusting EAP because the factory was there at midnight, and the washing away of the factory happened after midnight. So that would be a non-adjusting EAP because the factory was washed away after midnight, after the year end. It was washed away after the year end. And then what happens, is a few hours later we go onto YouTube. Isn't that the resource that we should have used in the first place? We go onto YouTube, and as it happens, there was a kid who was walking past the factory up in the hills above the factory, and he took a YouTube of the factory being washed away in the tsunami. No one was hurt, fortunately, but this guy who happened to be walking, out walking at night, he was a bit sleepless. He took a video with his phone of the factory being washed away. And you can see from his posting to YouTube that the factory was washed away at 11:30 in the evening, just before the year end. In which case you've changed your mind about this EAP. It goes from being a non-adjusting EAP to being an adjusting EAP, and you're going to write off the factory in the current FS, in the FS that you're about to draft. You're going to write off that factory because it wasn't there at midnight. And that's how it works. It's just based on that sentence. It is as simple as that. There is no layers of complexity there. Don't overthink it. That is how it works. So the EAP is always the discovery of something, and then you find out when the something happened, and that timing of that, the underlying something, then gives you the recognition. You know, it can be, you know, it can be all sorts of things. It can be, they tend to be fairly gruesome, to be honest with you. So it could be a murder. So the discovery of the murder is the EAP, but the timing of the actual murder, whether it's before the year end or after the year end, will give you whether it was adjusting or a non-adjusting EAP. Okay, that's all there is to that. Which brings us to related party disclosure, another good one. Again, just 1 mark. Comes up very frequently, but just 1 mark. Transactions. Between parties related by control or influence must be disclosed. And that's it, that's all there is to it. And again, it's not a particularly difficult subject, but it's often difficult to spot in the examination. You know, sometimes the examiner doesn't even spot it in his own scenarios. So he writes a 6-mark scenario and gives you 6 marks to discuss the scenario, and you can talk about anything you want to. And he talks about the 6 things he wants to pick out, but actually some of the students pick out in his scenario there's a related party transaction, and they get a mark for it. So in these discussion scenarios that tend to be, do you remember the exam is made up of question 1, numbers, bash, 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 and question 4 is the current issues question, and then sitting in between are the 2 mixed questions. So the examiner, he writes usually 7 scenarios. So it's 1, 2, 3, 4 in one, and 1, 2, 3 in the other. And in amongst these 7 scenarios, there's usually a related party transaction which needs disclosure. And even though it's in there, sometimes the examiner doesn't even spot it until the exam goes public and the markers start marking, and then it becomes obvious that of course there's a related party in there. And that's what it's like. There is a mark just for identifying the related party and requiring the disclosure of the related transaction. And not complicated, but difficult to spot. And the one that I was thinking about earlier when I was just drinking my tea in the kitchen just next door is not the easiest of ones. So you've got a little story about pensions, right? And you've got, here's the group and here's the pension. And what the group does is it transfers one of the investment properties into the pension, right? And that's the story. And because the scenario talks about pensions, you talk about pensions, and because the scenario talks about an investment property, you talk about investment properties, and you're doing great. But hang on, we're the group and here's the pension. Clearly those 2 parties are related because the group has control over the pension and there's been a transfer from one to the other. So that's a related party disclosure and that's a related party transaction and requires disclosure. And there would be 1 mark for spotting that in amongst the scenario. But that's the difficult thing, you see. It's not that related party disclosure is a difficult thing. It's just, it tends to be in amongst, there's this happening, there's that happening, there's this happening, there's that happening. Oh, and by the way, the CEO has borrowed a speedboat for a week. It's a story. The CEO has borrowed a speedboat. And you go, oh, the CEO has borrowed a speedboat. That's a related party transaction. It requires disclosure if you spot it. And that's what the mark is for spotting it in the scenario. That's that. Which doesn't finish us quite yet. I'm going to add an extra one at the bottom there. Probably actually, I don't know if you can see this, but we're actually coming to the end of that page. But actually those few lines there is probably enough for us. BK Sam has come up with a question, which is, I'll read to you and then he's going to answer his own question. How significant should the EAP be to warrant an adjustment even if it happens in the FY? How significant does an EAP have to be before we bother? So BK Sam, the question is, how significant does the EAP have to be before we bother? It's the same answer to how significant does a subsidiary have to be before you can be bothered to consolidate it? How significant does an error in depreciation have to be before you would correct it? How significant does the time value of money on a liability have to be before you discount it? How significant does NINYA have to be before you would do something about it? That's the question back to you. So your question back to you, what is the answer to that question? Back to this. Back to this. And a subject that has been on the syllabus for a while but has kind of resurfaced onto the syllabus. It's all right, you know, it's okay. See what you think. Agriculture. Not complicated, at least in theory. Agriculture. So wheat and apples and pigs are carried FVPL. Do you remember this fella? FVPL. I'm not sure how often I've mentioned it so far, but what does FVPL mean? Well, it means fair... Is that enough space? We'll give ourselves a bit more space. Fair value through profit or loss. And that is the whole subject. That is it. Oh, except this. In this, actually give myself enough space, just about. In this context, FV equals FVLCTS. Do you remember that fella? FVLCTS. It's the same alphabet soup as we saw when we were doing impairment testing. It's the same phrase. It is, if you recall, fair value less costs to sell. And I know I always refer to Sainsbury's, but I can't help myself because I'm right next to it. When I'm working in another studio, I'm a bit closer to Tesco's, maybe I'll talk about Tesco's or indeed whatever bank that I'm near. But I'm right next to Sainsbury's, and say you're on the Isle of Arran in northern Scotland, and as you can tell, I'm here in London, and we both hold the same number of shares in Sainsbury's. Now, if you wanted to sell your shares in Sainsbury's, what would you use to sell your shares in Sainsbury's on the Isle of Arran? You would use the internet. And what would I use down here? I would use the internet. There aren't any costs to sell, or at least if there are, they're very marginal, so we just ignore them. But the thing is about a cow is a very physical thing, and the further it is away from the market, the more it's going to cost to take to the market. The more it's going to cost to take to the market, the less it is worth. You know, if there was a market, we'll stick with a cow and we'll just imagine that there is a market here in London. Actually, do you know, I was reading, what was I reading? Of course, I was reading Charles Dickens, and there used to be a market right here actually in Holborn, just out there somewhere on the street, apparently. Oh no, just up the hill, that's right, just over by Newgate Prison. There used to be cows, livestock sold right here, right in central London. So we'll go back in time a little bit, and I've got my cow and it is here, and my cow is worth $50 if it's in market, and it isn't, it's just 100 metres away. So what is my cow worth here? Well, it's worth $50 or maybe $49. You know, the negligible cost it would cost me to take to across the way over to the market, just at the old Newgate prison, just over there. So my cow is worth $50, including the costs to get it to market, but the cost to take it to market are negligible, so my cow's worth $50. But your cow is on the Isle of Arran, and you've got a special cow that can only be sold here in London, and your cow is worth $50 in the market. It really is. It's worth the same as mine in the market, but the trouble is it's not in the market, and it's going to cost you $20 to take it from the Isle of Arran all the way down through England into London. Therefore, what is your cow worth in the field in Arran? It's not worth $50, it's worth $30, because it would cost $20 to take it to the market. And that really is how fair value works. So, you know, it is fair value, but in the context of cows, you have to bear in mind that, you know, cows and wheat and apples, they're physical things, and you have to actually physically take them to the market. You can't just sell them on the internet. Well, that's it. Apart from that, there's nothing else to agriculture. Oh, you don't know the answer to your own question, BK Sam. Interesting. Okay, the answer is materiality. At what point would you bother with an EAP? If it's material. At what point would you bother consolidating a sub? If it's material. At what point would you bother to correct an error in depreciation? If it's material. At what point would you bother to do discounting and unwinding of a liability? If it's material. That's the definition. So if the shareholders are likely to care. There you go, that's the answer. So how significant should an EAP have to be before it requires disclosure? And the answer is if it's material. Right, we're finished with that chapter. So goodbye to chapter 7 and hello to chapter 8, which is also very bitty. Oh, look at that, that's rather nice. We just got a nice page break just there across the middle. And here we go with non-current assets. And we'll just do a little bit and then, you know, rule off. And that'll be our life. We do a little bit and then we rule off, and then we do the next bit, and then we rule off, and then we do the next bit, and then we rule off. So here we go. I'll just get you the page in front of you. I've got the page number here, 124. But I get the page in front of us. So we've finished that now. Here it is. Non-current assets. There's the chapter title just there, and if you keep going down, you'll come to the first component of the chapter, which is cost, which really is spread across 2 IFRS. How rubbish is financial reporting? It can't even manage to get one concept in 1 IFRS. How rubbish is accounting standards? So cost. NCA cost is expenditure to get the asset working, including finance costs, which in this context are called borrowing costs. And to reinforce this, we have a lovely little question called supermarket. A supermarket chain build their own supermarket. Costs are as follows. Calculate and explain initial cost. So here's the calculation first of all. we basically have a shopping list of assets, and we have to decide whether we're going to include the cost in our definition of cost or whether we're going to exclude it. So materials. First, that figure of 30 materials, I guess if you build your own supermarket, it includes materials. The materials need to be included within the calculation. Labour. If you build your own supermarket, then I guess the labour costs need to be included. Legal costs related to planning are 2, and they are direct costs, whereas general legal costs cannot be immediately related to this supermarket and therefore excluded. I suspect you probably knew that one. The one you might struggle with is this one here, which is apportioned management time. And it's really down to examiner's interpretation here, and our examiner takes this view, which I think, agrees with the IFRS, but here it is anyway. Management time can be capitalised, but only if they can be proved to be specifically related to this particular asset. And in order to do that, the management would have to produce timesheets. And apportionment just isn't timesheets. And the problem that we have is that the cost has been apportioned. In other words, there's been a percentage invented to attribute some of the management time to this supermarket, rather than a real, connection between the management time and the supermarket and the evidence to prove it. Timesheets. There needs to be timesheets. So that is excluded. But included are the borrowing costs. Now, we have a 10% loan of 40 million was taken out for the full year. So 10% of 40 million is fairly obviously 4. But what we're trying to calculate here is not the borrowing cost itself, but the amount of that borrowing cost that's capitalised. And if you read to the end of that sentence, you'll probably guess what we do. But the building took only 9 of those 12 months to complete. That's right, you can only capitalise whilst you're building, giving you 3, and therefore 55. And the technical name for this cost, just before you turn on the depreciation like a tap, the technical name for this cost immediately before depreciation is called initial cost. And the question does demand some explanation, so we'll give a little bit. Won't say too much. Borrowing costs, first of all. These are only capitalised during building. And the other two, which were general and apportion costs, these are excluded because they are indirect costs. Or not direct costs, actually, is perhaps a better way of saying it. Let's just check this thing's working all right. How do we do that? Where are you? Right, there you go. Cha-chong. Yeah, it's working fine. Good, good stuff. Any questions, guys? Any questions, any thoughts, any comments, anything you want me to say? Moving on then. So once you have the initial cost, you then need to depreciate it over its useful economic life. This method of allocating cost over a life is called depreciation. And depreciation is typically slightly misunderstood. In a rather odd way, actually. Depreciation matches cost to life. And I guess everyone knows that. Anyone in corporate reporting, anyone in finance reporting knows that. But what the examiner thinks is that many students don't know this, but requires reassessment each year. So I guess that makes that a comma, doesn't it? Which, when written down, sounds completely blindingly obvious. But the examiner's right. Some students don't know this second part of the idea and don't know that it has this effect on the equation. Saying it out loud, most students think, is that true? Some students think that the formula for depreciation is cost divided by life, then repeat until dead. So cost divided by life, repeat till dead. But that isn't at all what the IFRS says. It doesn't say anything like that at all. But many students do think that is what the IFRS says. And the reason they think that is because that is how it is often done out there in the real world, which is ridiculous, bearing in mind this concept has been around forever. But anyway, it is widely misunderstood out there in the real world, so not unreasonably the examiner examines it in the fake world of his exam. So depreciation isn't difficult. Depreciation isn't difficult, but it isn't cost divided by life, repeat. It is take what you got left and divide by what you got left. Take what you got left and divide by what you got left. It is a remaining carrying value divided by remaining useful life. So there is a formula, but it's not cost divided by life. And the effect is that the examiner can catch some students out with a question called oops. And he does either exactly oops or more usually a variation on oops very frequently in the examination. Not in every sitting, but very frequently. And it's as you can see on the requirement, oops asks for financial statement effects for the first and second years, but actually in the exam it's usually set in the second year. But in order to do the second year, you have to do the first year first. So FS effects, here are the 2 years. So what I'd like you to do is to have a go at this. You'll never guess, I've done this question before. So I'll set you up with a bit of a pro forma here. and get you to have a go. So you can see that the language that I have utilised is very much the language assuming that the second year is the current year. So the first year's closing is the current year's opening is the idea I've got there. But have a little go at oops and see if you can tell me the figure. I'm going to use this also as a test just to make sure I'm coming through to you. So I'm going to wait until you give me an answer. The answer that I'm looking for is the orange fella. Can you tell me that orange fella there, the depreciation in year 2? So it's the orange fella that I'm looking for. And I'll just, take a moment's breather, have a drink of my tea and wait for the orange fella. Yeah, very good, very good. Bearing in mind that there's a bit of satellite delay between you and me. That's really quick. Well done, guys. I was going to read out the answer, but I think what I'll do is I'll just do it here in front of you because, of course, the guys who are watching this recorded on, Saturday and Sunday, they want to see it live, so let's have it. Oops, purchase a machine at the year start for 100,000. So, yep, let's get 100,000. There we go. 100,000 at the start there, believing its life to be 10 years, so they take 100 and divide by 10 years. That's bouncing all over the place. Goodness me, it's just a table. Wow, it's still bouncing now. That's slightly freaky. That is a very bouncy table. Giving us 90 and then reading on. However, during the second year, it is recognised that the original estimate of life was grossly overstated and that there are only 3 further years of use, including the current year. So a really good way of creating the right psychology with this second year is to do this. What the IFRS is saying basically is you do this. Actually, that's not even enough. It's more like you do this. There you go, more like that. So you just forget about what has happened in the earlier years and just concentrate on this year. You just take what you got left and divide by what you got left. It's a really good way of, creating the right psychology for this process. So 90 divided by 3 years gives us 30, and that's what you guys had, and there's a remaining balance of 60. Beautiful, beautiful, beautiful. And if I can just reveal what I have underneath the black there, you can see that we did ignore what had happened in the first year when we did the second year. But the reasons the examiner is particularly able to catch students out with this particular question is because there is a genuine trap in there, and if I can go to the class notes, I can illustrate that trap to you. You might have fallen for it. In fact, it might have sucked you in and taken a few seconds of your time, but it's here, which is so with hindsight, it appears likely that the total life is 4 years. The whole point is that there is no hindsight. There is no 4 years. You just take what you got left and divide by what you got left. That's the point. There is no hindsight. So not unreasonably, some students would be taken in by that last sentence. Great. And you can see that we've finished that subject, which is depreciation, and now we're into revaluation. In fact, revaluation and impairment sit quite together, quite well together. They're kind of like non-identical twins. So we'll work them together. We'll rule this fella off, and then we will work revaluation and impairment together. Revaluation and impairment. And they work really nicely as a table. So here is a table. And just to reinforce that this only applies to PPE, I will put that abbreviation at the top. Only property, plant and equipment. And what we'll do is we'll just start nice and gentle. A revaluation pushes the asset up and an impairment pushes the asset down. But it doesn't take too long before we get into some fairly horrible stuff. You'll recall from last time we met, Friday wasn't it, that there are two performance reports. There's the P&L and there's the OCI. If I can just remind you of the geography of that. Do you remember me saying that the performance statement is one single statement, ideally? When the examiner does it, it's one single statement. When Sainsbury's does it across the road, it's one single statement. But it's not, it's the two things on the one single statement are the P&L and the OCI. And because there are two components, it's tempting naively to assume that they're 50-50, but it's not like that at all. The P&L is usually, I think I did this with you, didn't I? The P&L is about 3/4 of a page and the OCI is around about 1/4 of a page. So it's very much the dumping ground at the bottom of the performance report. And you can see where I'm going with this. There are two fellas here. Revaluation on PPE goes to OCI because it's the law, and PPE impairment goes to P&L because it's the law. They're very, very similar, but they go to different places because that's the way it's done. There's no logic to that. And then it gets a bit tricky towards the end, very tricky actually. And I think what I'll do to get my head around this one is I will push you onto the right-hand side and just get you thinking about this. If you read a surveyor's report telling you that your PPE had fallen in value, could you ignore that information? So the surveyor has told you that your PPE has fallen in value. Can you ignore that information? The answer is no, you cannot ignore that information. It is compulsory to recognise an impairment if it has happened. But on the flip side, if you hired a surveyor and that surveyor told you that your building had risen in value, could you choose to ignore that information? Sounds like a strange question, doesn't it? But the answer is yes. If you hired a surveyor to tell you the value of your PPE and he told you that the value of your asset had gone up, could you then choose to ignore that information within the FS? The answer is yes. Revaluation is optional. Now, to get a little bit further with this, I now have to talk using the language of the IFRS here. The IFRS does use the phrase revaluation occasionally, but the proper name for the revaluation policy in the IFRS is called the fair value model. It's quite a nice name, isn't it? And the competing model against the fair value is called the cost model. So the cost model is cost less depreciation, and the fair value model is the fair value less depreciation. They still both depreciate, but there's the cost model and the fair value model. Quite good names, aren't there? Nothing wrong with those two names. So how does it really work? Well, the way it really works is that you buy yourself your first property, and at the end of the first year of having your first property, you basically have to choose between fair value or cost. And once you've chosen between fair value or cost, then that becomes your policy and you're locked into it from year to year. And also when you buy new properties, they get locked into the same policy. So when I say it's optional, it's not like you've got an infinite amount of choice, but really, in the first year that you get your first property, you really do have a choice. It really is optional. So how is the examiner going to tell you the policy that will apply to you in the exam? Now, this is now quite quickly getting quite complicated. This gives rise to a concept called the default policy. And I think what I'll do with the default policy is I'll just write it down and then I will interpret it. The default policy, that's supposed to be a C, not much of a C, doesn't it? There we go. Default policy. The default policy for PPE is cost because the fair value model increases depreciation. Well, that really is quite techy, isn't it? Quite a techy sentence. So we'll have a little go at that. I think to get anywhere with this, we perhaps have to take a step back and imagine that you're in the exam and it's the 8th of December and you're looking at P2 exam question 1. Now in question 1, the examiner will have goodwill, of course, and there are two policies with goodwill. There's full and there's partial. There's two policies with PPE. There's cost and there's fair value. There's two policies with PPE, there's cost and there's fair value, and there's two policies with goodwill, which is full and partial. Now, in question 1, I guarantee the examiner will tell you what the policy is. It'll either be full or partial. Usually full, maybe partial. Probably not partial, probably full. But how will you know that the policy is full? The examiner will tell you it's full. That's how you know. But that tends not to be the way the examiner communicates with PPE. Sometimes the way that you know that it's a cost policy on PPE is he says cost. Sometimes he says fair value. But more usually, he's silent. He says nothing. Now, this would never apply to goodwill, but as you can see, it does apply to PPE. So what you're supposed to do is to know that the cost model is the default policy. In other words, basically, what the examiner is saying is everybody does cost, and it is true. Everybody does cost, and nobody does the revaluation policy. Nobody does this thing you can do in the IAS. They all ignore it. That's maybe an exaggeration. Maybe one or two companies do revaluation of policy. Actually, do you know, I've been telling students for years that I've never seen revaluation, but I did actually see revaluation. I remember seeing it now. Just suddenly came back to me in a flash. So I've seen it very rarely in my career. It happens extremely rarely, and for all intents and purposes, everybody does cost. But in order to remember this, it might be useful to understand why everybody does cost. Well, most companies are motivated to try and compete with their competitors, and the CEO wants to make his company look the best it possibly can, both in terms of, brand competition out there in the market and also in the profit that's presented in the FS. And the way to make sure you do that is to minimize your costs. Now, if you go for the fair value model, it does make your balance sheet look stronger, which is good, of course. But the trouble with making your balance sheet look stronger is depreciation is take what you've got left and divide by what you've got left. The bigger the figure at the top of the balance sheet, the bigger your depreciation. The bigger your depreciation, the smaller your profit. So if you choose to have a fair value PPE, then you're choosing to have a lower profit, which would be very unusual. So the examiner expects you to know that the default policy for PPE is cost, because of what I've said there. Okay, and we're going to examine that, we're going to look at that idea in question blob. Question blob. But before we do that, I think I can see there's a question up here. I'm not quite sure what you're saying, BK Sam. I'll be very happy to answer your question though if you send me an email. It sounds like the sort of marginal thing that probably wouldn't be worth discussing here in the online classroom. But if you want to send me an email about your thoughts on that subject that you've just highlighted, please feel free to do so. So OOPS would not be an EAP, an event after the reporting period? No, it wouldn't be an EAP. Why on earth would it be an EAP? No. I think perhaps you're overcomplicating financial reporting. It is common for students to get in a bit of a mess with OOPS. So if you've gotten in a little bit of a mess with OOPS, just take a step back for a second and think what you try and do with every set of financial statements. These things that we call financial statements, they're communication vehicles, and the communication vehicles between companies and their shareholders. And what the companies try and do is they try and encapsulate what is called the true and fair view under UK law, and also quite commonly around the globe. But I actually think I prefer the American phrase, which is faithful presentation. They just try and tell the story as it is. But each individual FS is a package that's being delivered to the shareholders. And what you try and do is you make sure that this message is as good as it possibly can be. You package it up and then you send it off. And then the next one, you try and make sure it's as good as it possibly can be. You package it up and then you send it off. And then the next one, you make sure it's as good as it possibly can be, and then you send it off. So students tend to be just, automatically completely fine with provisions. Say, for example, you've got an environmental provision, which at the end of year 1, you think should be $1 million. What would you provide? $1 million. Why is that? Because you think it should be $1 million. And then at the end of year 2, you got more information about the damage that was done. And now you think that the figure should be 1.1. So what do you provide now? 1.1. Why is that? Because you think 1.1. Actually now, at the end of year 3, you're getting closer to the point where you are going to clean up the mess. And the engineers say that a more appropriate figure would be 1.5. So what do you provide now? 1.5. Why is that? Because you think it's 1.5. And that very natural thing that you do with provisions, it's just what you're doing with depreciation. Just take what you got left, divide by what you got left, and try and get this FS as best as you can. Don't worry about what happened in the past. That's all gone, Or everyone knows that financial reporting is based upon guesswork. The FS are supposed to be presenting, a faithful presentation. They're not some sort of guarantee of exactly, financial reporting has got guesswork in it. The provisions are guess. The useful excellent life is a guess. The sales is a guess. Everything's a guess. Everybody knows everything's a guess. But what you try and do is when you try and guess everything at each reporting date, you guess it as best as you can based on the information you have at that time. That's how financial reporting works. And it isn't unique to depreciation that you try and do the best thing you can in that particular year. It's just all things are exactly the same. You always try and guess the best that you can. And, I think maybe I'll just go a little bit further if you allow me. I think you're fine, Troy, but it isn't an error. It isn't an error. Troy, if I can, I'm going to assume you're a bloke. I'm going to assume you're a bloke. You know that gorgeous girl that you went out with when you were 16. She was gorgeous, wasn't she? Absolutely gorgeous. But also she seemed really bright and her friends were fun. So you decided to go out with her when you were 16. And you went out with her for 6 months and she was a total nightmare. And then you dumped her. Now, having gone out with her for 6 months, obviously, you now got the benefit of 6 months history. She's a nightmare. But it doesn't mean that you were an idiot to go out with her in the first place. Based on the information you had about that girlfriend before you went out with her, she seemed okay. I mean, of course, everyone can make mistakes with girlfriends and boyfriends. You know, if you go out with a girl who already looks like a nightmare before you go out with her, then obviously that's idiotic, and that's technically called in financial reporting an error. But an error is, you know, something that you obviously shouldn't have done based on the information you had at the time. And you're not allowed this hindsight thing. You can't go, that was an error because I now know it was wrong. No. What did you know at the time? At the time that you were considering that 16-year-old girlfriend, when you were 16, she seemed cool, so you went out with her. So that was the right thing to do at the time, because otherwise you wouldn't do anything. So that is how all financial reporting works. And an error is not something you're allowed to apply hindsight to. Okay, so that's how it works. Should we say that's enough said? Back to this fella, Blob. Basher, smasher, crasher. 3 machines. Blob have 3 machines that are suspected of impairment. The figures are as follows. Well, we have a carrying value at the year end before the impairment test of 300 for the first, 400 for the middle, and 500 at the end. And then we're going to record the impairment to give us the after figure. VIU, fair value less costs to sell. And I'll start with the first one. 290, 110, and we want to analyse this thing called recoverable value. Recoverable value is literal. It is the value that we expect to recover from the asset. It's our asset. We can do what we like with it. If we use it, we will get 290. If we sell it, we'll get 110. So which would we do? We'd do the 290. We'd do the keeping and using, which is the higher. Why do we use the higher? Well, we use the higher because that's what the IFRS says. But why does the IFRS say so? It's because that's how humans behave. Then the recoverable value is compared to the carrying value. It is seen to be lower, and therefore we slot in the 290 and we get 10. Now, what I'd like you to do is have a go at working your way right the way across. And this time I'm going to test you on, we'll go orange again because orange seemed to work for me. It is a trick. Could you try for the orange fella? Try for the orange fella. It is a trick, but try for the orange fella. Wow, that was very quick. You're absolutely right, Troy. So let me catch up. So I've got data for the middle one, which is 170 to 30, and I'll take the higher 230. Then compare the 230 to the 400, see that it's below. 230 then goes in, and just see if I can get that to go up. There we go. My arrows are not too good, but not too bad. And therefore the balancing figure is 170, and you can see that the left two guys above my shoulder, they're both the same, aren't they, really? But the one on the right is very extreme. It's got a value in use of 540 and a value at sale of 20, so we're definitely going to use this asset. So we take 540 as being what the asset is worth, and then we test to see if there's an impairment. We test to see if the recoverable value has fallen below the carrying value. We test to see if the recoverable value has fallen below, and it hasn't, it's above. So If there is no impairment, the size of the impairment that is recorded is 0. If there is no impairment, the size of the impairment that is recorded is 0. That's cute, isn't it? So there is 0 impairment. Now, if you somehow slotted a figure of 40 of pushy uppiness into this orange zone highlighted here, then you are wrong. Because what does the question say about the policy on machines? Nothing. It's silent. So what is the default policy? The default policy is cost. And even though the examiner hadn't told you it was a cost policy, you're expected to know that the default policy is cost, and therefore your mangled revaluation-y type of thing where you've pushed the asset up, that would be marked wrong. It'd be marked wrong because it's wrong. So the one highlighted in orange over here, it is a trick. It is a trick, but it does happen in the exam. The examiner does ask you to do an impairment test, and the result of the impairment test is that there's no impairment. But that's not that common. The more common one is the wonderful question AB over the page. Really good, really good. Great. So the other question is called AB. The other question on impairment is called AB, and that's the question we're going to look at now. It looks at a subject called allocation of an impairment at a cost generating unit, which is a bit of a mouthful, but we'll have a go at that together. So AB. It's over the page. I feel like bringing it up over my shoulder, so I will. Here's AB, and you can just about see on the screen to my, what will it be, down here somewhere? To my left it is, to my left, that the requirement is describe how AB should be treated in the above financial statement. So we're going to give a little bit of an intro. Now, AB acquired a car taxi business, and in the context of an impairment, a business is called a cash generating unit. It's just the way the language is used. It's a bit naff, I think, but it is the way the language is used. So here we go. Let's learn about allocation. Impairment is allocated in a cash generating unit as follows. Impairment is allocated in a cash generating unit as follows, and it goes 1, 2, 3, B, which is not enormously rhythmic, but is the way it goes. And this shopping list that I have over here is the formal version of what you've learnt with me already in subsidiary impairments. Who leaves first? What leaves first when a business is in trouble? Is it people or things? What leaves first when a business is in trouble? Is it people or things? It's people, isn't it? And therefore you are right. The first thing that you write off is goodwill, except you can see where I've slotted this. It's not the first. And I always find it works really well if I give an example of this. And I've been using all sorts of examples, but the one I was using, I must have been on Tuesday when I was teaching exactly the same thing online, really worked for me. So I found it really worked for me because I live in London. It's a story of a Greasy Spoon cafe. So there's a Greasy Spoon cafe serving bacon, egg and chips for breakfast with a cup of tea, with a spoon in it. And that cafe has customers, of course, but just behind the counter, a boiler explodes across the room, and sadly some of the customers are hurt. And as a consequence of some of the customers being hurt, those customers never come back, and their family never comes back, and they tell their friends, and those friends never come back. And it is absolutely right that the goodwill is completely battered by this explosion of the boiler. But what should we write off first before we write off the customer goodwill? The answer is kind of obvious. The answer is the boiler that exploded. And that's the idea there. If something has exploded or broken or stopped functioning or rusted or died, then you write it off first. So you write off specifics, then you write off goodwill, and then you write off the rest of the balance sheet, the remainder. But the remainder of the balance sheet is enormous. So you need a method to allocate between them, and the method is called weighted average. Right, weighted average? Yes, weighted average. And the last thing is whicher, but never impair below, how shall I say it? I think I'll just say it like that. Never impair below FV, which does sound pretty technical, but again, it is obvious when an example is given to you. Going back to the Greasy Spoon Cafe, the Greasy Spoon Cafe has been prudent with its money. It has saved up 50,000 UK pounds. No matter how bad business gets, what is 50,000 UK pounds in a bank account worth? 50,000 UK pounds in a bank account is worth 50,000 UK pounds. So don't go round saying that a £50,000 bank account is only worth £40,000. That would just be silly. And that's the idea of the B. So 1, 2, 3, B. And then we're going to have a go at allocating the impairment described in the story against the assets. But, you know, being a Graham Holt question, it's got a trick. The assets have a trick. Now, let's do some application here. This applies to the taxi business as follows. And there's a certain way of laying this out which the examiner always uses at the year end, but before the impairment in the first column, then the impairment, and then the after column. And because the question's been written to be answered in this way, it works in this way. Now, the examiner has been rather cruel in hiding the goodwill from you. So I'll highlight the goodwill by flipping across to the question now. Here we go. So AB acquired a car taxi business on the 1st of January for 230,000. The values of the assets of the business at a date based on book value were as follows. 190 is the net assets. What is the difference between, you know, the whole business is made up of people and things. The things are 190, so what's the people worth? It's worth 40. And of course, the technical name for the fair value of the loyalty of the people at the point of acquisition is called goodwill. And then we just copy out the rest of the guff. And the technical name for the subsidiary in the context of an impairment is CGU, CGU, cash generating unit. And let's add down, make sure this scans, so 100, 160, 200, 250, 230, yep, that does work. And then we just start reading the story and dropping stuff in as we read it. On the 1st of February, the taxi company had 3 of its vehicles stolen. The net selling value and net book value of each vehicle was 10. So 3 vehicles were stolen worth 10 each. We're going to knock off 30 to leave us with 60. Because of non-disclosure of certain risks to the insurance company, the vehicles were uninsured. Also on the 1st of February, a rival taxi company commenced business in the same area. It is anticipated that the business revenue of AB will be reduced, leading to a decline in the present value and use of the business. So that's the VIU of the whole business. The VIU of the whole business is 140 after this decline. It is unlikely the business could be sold as a going concern, which is a bit dodgy, isn't it? What does that mean? Well, fair value less costs to sell. It either means fair value less cost to sell is 0, or it means it's just it's a non-applicable concept. Either way, the higher of those is clearly this figure of 140. Just let me see if I can line that up nicely. So like that, there we go, it's quite nice. 140. And therefore we can work out a balancing figure of 90. Oh, wait a second. What is this 90 called? That 90 is called the impairment. And what we're going to do is we're going to smudge the 90 across the yellow area. What's it called to push the 90 across the yellow area? It is called the allocation. Wait a second, I've already started the allocation. Oh yes, just because of the way this question reads, I've already got this down as a number 1. So I'll reinforce that now with the little number 1 there. Reading on, the net selling value of the taxi license had fallen to 25, so that's the intangible. 25, and there was a 5 here, and I'll call that number 1 as well. It does actually sound like the second thing that happens, but that's not what I'm referring to here. I'm referring to both of them as being specifics using the shopping list idea. And you can see that 35 of the 90 has been written off. It's nowhere near enough. So what we're going to do is going to kill off goodwill altogether, stone dead, and that's number 2. And you can see that even that is insufficient when we compare the, that's not what I meant to do. When we compare the yellow to the orange, you can see that there's a missing 15. So we're going to allocate the missing 15, but we're going to avoid being daft. But don't be daft, says that rule up there, the B. So payables, we don't owe more to our suppliers just because we're in trouble. So that's the idea of leaving that one still. The cash at the bank is still worth 50. That's the idea of, but don't impair below fair value. Now receivables would be unlikely to impair, but in this case they definitely don't impair, because if you take a look in this question, the question clearly tells us that these receivables are already at recoverable value. There's that horrible pink. So they're already at their fair value, they're already at what they're worth. So don't touch that. It tells us in the question that the intangible 25 is what we could sell it for, and also the 60 is 6 times 10, and each of those vehicles could be sold for 10. So rather oddly, it is a little bit difficult, but what we're looking for is the assets about which the examiner is silent. And the examiner said nothing about the garage and nothing about the computer, so we can attack it. Which is a bit weird, isn't it? But that is the way the game is played. If the examiner tells you something about an asset, he's telling you keep away. If he's silent on the asset, he's saying get in there, attack. So we are going to attack those two. And those two, of course, are 2. So we could divide the remaining 15,000 just half and half. But that doesn't seem very fair because there seems to be a ratio of 2 to 1 here. And that's the idea of weighted average. So how do I feel like writing this? I'm going to write it like this. So there's 15,000 that's been split between these two on the basis of 20 over 20 plus 10 and 10 over 20 plus 10. And that process on the left-hand side, highlighted here in blue, that process, that is called weighted average. Especially this bit is called the weight. That's called the weighting. So that process on the left there, that's called weighted average. Oh, okay, all right, that's how it works. So that gives us 10 and 5 as our number 3. And therefore, indeed, 10 and 5. And there you go. It's quite nice, that question, isn't it? But not so frequently asked now. The examiner has a bit of an obsession about this subject of reversal coming up now. He does still examine that, but perhaps not in quite so much detail as he did when he examined the question AB. AB is a real examiner question from a little while back, and the examiner still, repeats this. It's in his, it's in his portfolio of things that he examines fairly regularly, but not as regularly as the subject of reversal. I don't feel like ruling off here actually, because reversal is like a continuation of what we're doing, which is revaluation and impairment as a pair. And what a reversal is it is the reversal of a previous revaluation or the reversal of an impairment. So let me write that down for you and then we'll talk about it. So here we go. Reversal. A reversal occurs when PPE goes up and then down in value, or the opposite. So what's it called when an asset goes up? A revaluation. What's it called when an asset goes down? An impairment. What's it called when an asset goes up and then down? It's called a revaluation and a reversal of a revaluation. Okay, that's the idea there. And there is a really techie rule that applies here with less than perfect perfection. But here it is. Limit a reversal is limited by HNBV, which is historical net book value. Which is the carrying value that would apply if there had been no up or down, just depreciation. And this concept of the limit is absolutely central to our delivery of this subject. But as you can see from that jumble of words on the screen there behind me, it's really technical. And it doesn't help, I don't think, to over-focus on that concept of the limit, to get into the idea of reversal. And that's why we're going to start with the baby question, revert. The real question's called rethink, but we'll get into the groove through the question revert. A company purchased some land on the first day of last year. It has the policy of revaluation of land. The cost was 400. At the current year start, the asset was pushed up to 410, and then it was pushed down to 397 at the current year end. Required is discuss the effect of the above in the current FS. So here we go. Here's the story. So FS effects. Here is the numbers. So we have an opening cost of 400, and then we have depreciation for the current year of 0 because it's land, and then the opening cost at the beginning of the last year was 400, and the closing figure at the end of the last year was 410. That's our current opening. And you can see there's a gain of 10. No prizes for figuring out that balancing figure. But how do we describe that 10? We describe it as a PPE revaluation. Or more to the point, it would have been described last year as a PPE revaluation and would have gone to last year's OCI. And then this year the fall in value is all the way down to 397 and therefore is a fall in value of 13. But here's the problem, the fall in value is split across the performance report with some of it up there and some of it down there. First of all, what we have is a reversal of PPE revaluation, which will go through the current OCI. Then we need the HNBV in between. And then the, what's this fella here? The remainder of the fall in value is just called an impairment and goes to the P&L. And we do indeed have a figure of 397, and you can see that if only we didn't have a split performance personality between P&L and OCI, all we'd have would be a fall in value of 13, and this would be so easy. But it's not so easy because of the split of performance reporting between OCI and P&L. It's not easy, so let's just learn it how it is. So what you do quite intuitively is say to yourself, I think the reversal will be the same as what happened last year, so I think that's going to be 10, the rest is 3. And that is technically correct, but that is not the way to work out the answer and doesn't work for rethink. So you have to learn the proper way of doing it. The proper way of doing this thing over my shoulder is to first of all identify the historical net book value. Now, what figure would we have had if we had not had the up and down that we did have? We did have an up and down, but what if we hadn't have had an up and down? Well, this is land, it wouldn't have had any depreciation, so we'd still have now the figure of 400. And the way to properly work out the closure of this story is that the three blue figures are fixed, and then both yellow figures are balancing figures. And that doesn't become obvious until you do the question rethink. So let's do the question rethink and rethink what we have up here on the screen. A company purchased a warehouse on the first day of last year. The warehouse had a life of 10 years from purchase, and this estimate is unchanged throughout. The company has the policy of revaluation of property. So the same request is that FS effects on the current year. So FS effects. Here is the movement. So we have a cost of 8 million. Is it million? It is million. And then we have depreciation for the first year. Life of 10 years, so it's 8 divided by 10 years gives us 0.8, and therefore 7.2 is the closing carrying value at the year end before the PPE revaluation, which is going to go, or will have gone, to last year's OCI. And the first year closing is the current year opening figure. And is a figure of 10. There we go, got it. And therefore 2.8 as a balancing figure will have gone to last year's OCI. And, oh, ran out of space. So here we go, just skip down and then go back up again. And it's very similar to what you've seen before with redaction. What you do in order to get things right in the new year, in the current year, is essentially this. You know, you just forget about what you did in the first year, just start with a figure of 10 and off you go. You just, you know, get rid of all that nonsense and off you go from there. You can still just about see it under there, can't you? But ideally, I've redacted it all together. Well, here we go. So I'm going to ignore what happened last year and just carry on. So carrying on, we have depreciation in year 2, where you take what you got left and divide by what you got left. So I've got 10 divided by 9 years gives us 1.11 or whatever you want to say, giving us 8.89, which is the current year end closing figure before the nonsense. Then the nonsense kicks in. First of all, it is a reversal of PPE revaluation. Yep, that's right. And it is going to go to the current year's OCI. Then you need the historical net book value, which is the figure you would have had you not had any nonsense, just had depreciation. And then we have the impairment. And then we have the closing. Like so. And I almost don't want to do this, but I think I probably should. What you mustn't do in the exam is make a connection between these two. There. Oh, I've not done that quite right. Sorry, I've not done that quite right. How am I going to do this? Like this. I'm going to go wodja between this one and wodja that one. It's very tempting, isn't it, to make some sort of connection between those two fellas there, make them both 2.8 or something like that. You can actually do some fancy stuff to show that there is a connection between the 2.8 and the figure down here, but the connection is not immediately obvious, and the easiest thing to do is just don't make the connection. So I'm just going to shunt that out the way so we're not tempted to make any connection. So there you go, it's gone. So now we'll just work from here. I'll put in those colours I had earlier. We're going to have blue, blue, blue. And once we have all the blue, we're going to drop in both yellow fellas as balancing figures. Like so. Both of them. Right, so we know the closing figure is 4. So we do know that the fall in value is 4.89, but now we need to split it between OCI and P&L. And the way we do that is by picking up the historical net book value, which is the figure you would have had if you hadn't have had any messing around, you'd only had depreciation. So we did start with 8, and we did have 0.8 in depreciation, and if nothing exciting had have happened, we'd have just had another 0.8. And that's it. That's how the figure works. And why am I looking around for a calculator to work this out? I can do that in my head. 6.4, therefore, and then you can see how this is working. We get 2.49 sausage and 2.4, and there you go. That's how to score the 4 marks as given by the examiner. He's examined this quite frequently. I was just working it out in my head when he did this one last, and he actually examined it last in the summer, which doesn't mean it's not coming in the winter. It could come, summer and winter. That would not be unusual. But annoyingly, last time he examined it, he only gave it 3 marks, whereas he's examined it many times before that, every year, for a few years now before that, and always given it 4 marks. So it'd be a bit disappointing to reduce the mark allocation, but there you go. If it's 3, it's 3, I guess. Okie doke, okie doke. And that's it. It's good, isn't it, that one? And as I say, commonly examined. We're still just on the borders of the same subject for a tiny little mini subject that does get examined. That was last examined in winter last year. And this fella does get examined. It's very simple, but hard to remember. Goodwill reversal. Goodwill reversal is forbidden. There you go, that's the whole subject. Goodwill reversal is forbidden. It is quite possible, we had the greasy spoon. Let's go back to the greasy spoon. So it is possible that the greasy spoon will mend its boiler, get its customers going again. It's working in London, so before you know it, all the people that are living around the greasy spoon have all moved out anyway. And, people are always moving in London. There's a lot of churn in London. So, the cafe, it gets back to full health and it's rammed with customers and the customers are back. That might be true. The customers might be back, but you are forbidden from pushing the goodwill back up again. It is that simple. Goodwill either flatlines or it goes down, or it flatlines or it goes down. It never goes up. Just a rule. Just a rule. And now we are finished. So any questions on the subject of impairment, revaluation, reversal, anything in that sort of midsection before we move on? Okay, moving on then to grants. Probably the last little baby exercise that I'll do. Grants is highly numerical and can't really be taught without an example. It doesn't really say much. That the concept for grants is PPE, NCA in fact. NCA is recognised at gross cost. question. Grant Mitchell. And it's not obvious what that means, but it does become obvious once you work on the PPE with me. So have a look at the story. Grant Mitchell at the bottom of page 129. A building costs a net of 100 at the year start, and the government pay the supplier an extra 20. So the movement in the PPE is, the cost is 100 paid by us, that's called the net, and 20 paid by the government, that's called the grant, to give us 120, and that's the gross cost. You guessed that already, right? And then depreciation, we take what we've got left and divide by what we have left. Give us 6. You can see at the bottom there the estimated life of the building is 20 years. Gives us 114. Closing. And then we have the liability. I'm never really sure exactly how to communicate the feel for this, because there's lots of different ways of describing it, and some ways work better for some students than others. But I must say that although I'm not a massive fan of double entry, I do find double entry works well for me here. So I'll talk it through in a very mechanical way, like I was a bookkeeper almost, and I hope it works for you. So imagine I am a bookkeeper and I'm locked in my books, sort of remote from the real business. The first thing I notice as regards the purchase of the building is not the new building, which is, you know, many blocks away in an industrial estate and remote from me. But what I notice is a figure of 100 million flowing out of the bank. So 100 million flows out of the bank, and that's a credit to the bank, isn't it? The credit to the bank automatically generates the debit to PPE. So we've got the yellow debit to the PPE through the bank. Okay, the credit goes out of the bank, and therefore the debit goes to PPE. And then we speak to the bookkeeper, right? We speak to the CFO maybe, and the CFO mentions to us that not only did we pay 100 million for this building, but the government also paid the supplier 20 million on our behalf. And so we think to ourselves, right, okay, I remember the game here. We are required to recognise the asset at gross cost. So that gives us the debit balance of 20 at the top of the balance sheet. But there's an expression, balance sheet. Balance sheets are required to balance. And the only way to balance this 20 at the top of the balance sheet, debit at the top of the balance sheet, is with a creditor, credit the creditor at the bottom of the balance sheet. So we credit the creditor at the bottom of the balance sheet in a section called liabilities. And we just call that creditor the grant. And there goes the credit balance into creditors. But of course that grant is grant income. And we need to release a little bit of that income into the income statement. So we call the income that is released to the income statement income. Now the income doesn't have a life. That 20 doesn't have a life. But it's related to the building, which does have a life of 20 years. So we release just one of the 20 and we leave behind 19 in income. And that income that's held on the balance sheet is called deferred income. Both the 1 and the 19 are both income, but one balance for the income is in the income statement and the other one's down there at the bottom of the balance sheet. And held on the balance sheet is deferred income. And that's it. That's really pretty much it. So we create a balance sheet with 120 at the top, 20 at the bottom, and then the two of them decrease in value. The decreasing in value at the top of the balance sheet is called depreciation, and the decreasing in value at the bottom of the balance sheet is very similar but not called depreciation. It's usually just called the releasing of the income. And speaking of the income, perhaps we should gather this all together in the P&L. The P&L balances gather together as follows. So the P&L balances gather together as follows. The depreciation goes into the P&L as a cost, of course. The income goes into the P&L as an income, of course, and the effect is net depreciation of 5. But the point is that this 5 here, most important of all is that this 1 can't go to the top of the P&L. It can't go into revenue, okay? And what everyone does in real life and what the examiner does in the exam is he makes the income follow the depreciation a bit like a poodle, you know, so, or a bit like a dog. Ruff, ruff, ruff. So if the depreciation goes into cost of sales, then the income follows into cost of sales, and it will give you a net cost within cost of sales of 5. Now, whether this goes into cost of sales, admin or distribution will depend upon the nature of the building, and you can see that the building is just described as a building, so we don't know what it is. But if it was a warehouse, the 5 would go into distribution costs. If it was an admin block, then the 5 would go into admin, and if the building was a factory, the 5 would go into cost of sales. Okay, that's the idea. And that's it. That's it. And that is also the last example that we need to do. And we need to do a couple more subject matters, 2 I's as it goes, investment properties and intangibles, and then we're finished. And I can see based on the time that we have here, it's 8:20 here in London. That's where we'll be drawing a line, which I suspect it might be the case when I started out at the beginning of the 2 hours, which means that we will be doing leases and the other 2 employee things. What are they? Employee benefits is pensions, actually. We'll be doing employee benefits and pensions and also share-based payments as well as leases next time I see you, which is about right these days, to be honest with you. This stuff in the middle of the syllabus, you know, it's very tempting to dumb it down. You can picture I could really dumb it down and just sort of shovel it all together and just knock it out in an hour or something like that. But it just isn't appropriate to your P2 examination. For some of you, of course, this stuff is new to you, in which case you definitely need the full-time allocation. But for even if you've done F7 and a lot of this stuff is very familiar to you, it still needs reinforcing, because the examiner is doing more and more of this kind of central stuff and less on the rocket science as the years go by. Don't get me wrong, there might be something on share-based payments, but it'll probably just be a couple of marks here or there. Whereas maybe, 10 or certainly 7, 7 or 10 years ago, you might have gone into some depth on share-based payments or some depth on pensions. But these days, to be honest with you, it tends to just sort of knock them out the way like that. So we won't disrespect them next week. We'll give them a proper go. But to be honest with you, we'll probably spend more time on leases, because this central stuff in the middle of the syllabus tends to be most of where the mixed questions are. It's coincidence actually. Question 1 is your numbers, question 4 is your current issues, and question 2 and 3 in the middle tend to do this sort of middling type of financial reporting. Enough said, let's do investment properties. Investment properties are obviously two things. They are investments and they are also properties. But as far as the IFRS is concerned, they are more investments than they are properties. So they're carried FVPL. IP are carried FVPL. Fair value to profit or loss, as we saw earlier. In other words, they're carried as speculative assets, which feels right to me. But there's no mention of depreciation there. And therefore, there is a motivator for creative accountants to treat all their properties as investment properties. So there are criteria preventing this creative accounting. And the criteria are ice, baby. Dun 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 dun. Ice, baby. An investment property must be an investment. It must be complete, and it must be entity unoccupied. Entity unoccupied, that's the fancy one, that's not occupied by the group. Complete means finished. If the building isn't finished, then it's work in progress. And investment means held for gain or rent, or most usually both gain and rent. And that's it. You have to fulfill all three criteria. If you fulfill all three criteria, then the asset is investment property and will be carried FVPL. If you fail one of the criteria, then the investment property is not an investment property, but it's still a property, so it would drop into PPE. It's all right, that, isn't it? That's that one done. And the last one is intangibles. Which you probably know a little bit about. But probably what you know is the useless stuff, if I'm honest. You probably know that there's an intangible called development costs. And when was I teaching this last and talking to students about it? I was teaching this, I think, last week or the week before, I can't remember now. I'm talking to live students in the classroom about this one. And I actually worked out the last time the examiner actually examined the criteria. It was in a question called Polar Speed, a really good question. But I couldn't remember the date of it. It's like ages ago. I think it's 2003. So you are expected to know that there are criteria for development, but you're not expected to know what the criteria are, at least based on the last 12 years of history. So development expenditures is capitalised if you fulfil criteria. Development expenditure is capitalised if the project fulfills criteria. That's it, that'll do. Yeah, that'll do. The one that gets examined regularly, I'm going to teach you it in full, but it's even more simple. No, it is called intangibles, but let's use a better phrase. Other intangibles, rather inelegantly. Other intangibles. This is the full criteria. It's great. These are capitalized if purchased. That is the criteria. Isn't that just beautiful? That's not under teaching you. That is the full criteria. It's fantastic, isn't it? And if you buy the asset, then you capitalize it. If you created it yourself, you don't. And it isn't difficult. It really isn't difficult. But students tend to struggle with this area, and sometimes they do struggle with this area because they haven't got the intangibles sorted in their heads. So if I can just spend a second talking about intangibles, I think you'll get much more of a feel for it. Students tend to come with all sorts of fancy names for intangibles like royalties and patents and things like that. They're all very legalistic names, but it's much, much better if you, and trademarks, and they're all bits of paper and contracts and stuff like that. That isn't what an intangible is. These pieces of paper that you're referring to are just pieces of paper that are legally encapsulating the intangible itself. The intangibles themselves, although you can't touch them, they're not complicated. My favourite intangible is songs. So my favourite writer at the moment, is that true? Probably true, is Ed Sheeran. And the reason that Ed Sheeran hasn't capitalised any of his songs on his balance sheet is he didn't buy any of his songs. He wrote them all himself, okay? But there are many companies in the world, specialist companies in the world, that buy songs from songwriters and then try and get those songs to be recorded by artists. And there was a French one that my wife audited. It was a great audit. She was able to get me across to Paris, and we spent a week in Paris together. I was going to the Louvre and she was auditing during the day. And this French speculative song house went round buying songs from songwriters, and they cost very little, like 10,000 euros each. They would then pay the songwriter would disappear, and then they would own the song. And the most famous song that they bought is I Would Be Your Hero Baby, as you know, recorded by Enrico Iglesias, but owned by this French speculative songhouse. So they capitalised their songs because they bought them. And then you've got other things like, cartoon characters. Oh, I'm sorry about that, guys. There's a function there I intended to use and it didn't come out as the one I intended. Cartoon characters. How am I doing for time? Time to wind up. So I'll end with cartoon characters. And the really good example is Disney. Disney own two very famous cartoon characters. One is Buzz Lightyear from Toy Story, and the other one is, there's lots of them, but I'm picking out two, is Mickey Mouse. Why did Disney capitalise Buzz Lightyear? Because they bought Buzz Lightyear when Disney bought Pixar. Disney bought Pixar. Did you know that? Disney bought Pixar many years ago, not long after Toy Story 2 was created. So Toy Story 1 and Toy Story 2 were independent, and Toy Story 3 was actually created through the Disney version of Pixar. If I've got those dates right, roughly right, I think I've got them right. The point I'm trying to make is that Buzz Lightyear was purchased as part of a sub-acquisition, but purchased. So why is Buzz Lightyear on Disney's balance sheet? Because Buzz Lightyear was purchased. But why is Mickey Mouse not on Disney's balance sheet? Because, Walt Disney drew Mickey Mouse. Walt Disney created that cartoon character, so he's not purchased. And that's how to look at it. These things are what these intangibles are. They're songs, they're cartoon characters, they're movies, the software, the apps for mobile phones. You know, that they aren't tangible literally, but they're not so remote as sometimes students make the language sound. So if you know, the examiner, there's a really good example where the examiner examined fishing rights. So it was a right to go fishing in a certain area. And many students tried to discuss this intangible fishing right without using the words fishing or right. I mean, how can that be possible? How can you talk about fishing rights without talking about fishing? They were frightened of just, you know, the fact that it was a fishing right. It's just a right to go fishing, you know, just picture an area of fishing and it's a right to go in there. And it's just an intangible, and they bought it, so it's capitalised, you know, off you go. And it wasn't complicated at all, but students were frightened of it because they felt not only was the, you know, the intangible, as in, you know, they couldn't touch it, but they couldn't touch it at all. They couldn't go near there because they were frightened of it. Enough said. We've finished the chapter. Hoocha! Well done. Let's go big head. Actually, we don't do that anymore, do we? Let's go back to evening 5. In evening 5, we did performance reporting and provisions. This was evening 6. We've done all of non-current assets, but we haven't done leases. Leases we will be doing with you next time. And next time we will be working, we should be okay. It sounds a bit intense, but it should be fine based on the examiner's new attitudes towards employee benefits and share-based payment, which is kind of to marginalise them. I miss them a bit, if I'm honest, but you know, I've got to make sure I allocate my time in accordance with the examiner's attitude currently. So we'll be doing employee benefits and share-based payment, but also we will be doing leases. So I look forward to seeing you then. Have a super week, and I will see you next Thursday for the next exciting instalment of P2 Corporate Reporting with me, Martin Jones. Have a good week.